Hello everyone, welcome to Bald Guy Money. I am Bald Guy, and we finished this past week in fear territory on the Fear and Greed Index, and as you can see here, we are very close to breaking into the extreme fear area, meaning regular people are getting nervous about a potential pullback in the stock market because it's where they have the majority of their investments. Now, to be fair, I suppose they should be fearful because from my point of view, a correction is at least 6 months overdue now, but when we look at institutional selling, which is what you are looking at here, this gives additional cause for concern because this indicates that important insiders, those who are executing transactions of $100,000 and more, are heading for the exits. And because it may not be completely obvious from that graph, if we zoom in a little more to look on the largest stock transactions over the last 60 days as they pertain to single companies, you can see here that the sell to buy ratio is 2.75 sell transactions for each buy transaction, and if we exclude the huge stock deal on Public Storage at the top of the list, which has a specific set of circumstances surrounding it, you can see that the ratio jumps to nearly 20 sales transactions for every one purchase, including large insider selling of Palantir, Walmart, and Amazon. Now, with all that selling at the start of the year, the major stock index, the S&P 500, has taken a dip, down almost 1.5% on the year so far, while metals are up, driven in part by China's central bank gold buying at $2,600 an ounce, mind you, which makes you wonder if they aren't putting a floor in at that price, as well as their increasingly aggressive economic stimulus, which is bolstering the price of silver, which is back above $30 an ounce again. And while this may only be a preview of what is coming over the next 6 to 8 months, it teaches us an important lesson about not having all of our eggs in one basket. And of course, I am referring to the stock market crowd, as well as the critical importance of having gold and silver as a pillar of your portfolio. So in this video, I want to show you all the massive risk that people who are relying on 401ks for their retirement are exposed to right now. Then I want to show you with hard facts and data how that risk can be partially offset by gold and silver, including some price forecasts. And once that's covered, I will answer a viewer question on the topic of asset tokenization, which is something we got into last week, how it is associated with the Great Taking and my interpretation of that, as well as what you realistically need to know to protect yourself in this scenario. Now, just before we dive in and right before the market fireworks start, for each and every one of you who wants to pay less on premiums for gold and silver when you buy and get more back for your money when you sell, please go and sign up for early access to the goldsilverswap.com marketplace. It's the latest innovation in my cooperation with Summit Metals, aimed at putting the power that dealers and local coin shops have on the market in your hands with a user-driven marketplace and verification options that make it as safe as buying from your trusted dealer while getting you a price as close to spot as possible. That is www.goldsilverswap.com. Link is in the description below. The big launch is coming soon, but this is a game changer on both the buy and sell sides for gold and silver. More coming on this soon, but please sign up for early access today because it's going to be absolutely worth it for you. Okay, so getting into it, I already mentioned that stocks look to be topping out, and after a short rough patch, metals are regaining a bit of momentum, for now at least, and as a result, silver and gold together are now more valuable than all the other assets on this list of top 10 assets combined, which means that all the gold and silver in the world could buy you all the companies listed here as well as all the Bitcoin in the world. And as I've suggested before, I think we will get to a point where gold and silver reach around 70% of the value of these top 10 assets as they zoom off to higher levels, making a V-shaped recovery in the aftermath of a market correction. And for people who are totally relying on a 401k or other stock portfolio for their retirement, that should be a major point of concern, because on one hand, we all know that people don't save enough for retirement to begin with less than 40% of Americans in all age brackets having more than $100,000 saved for retirement right now. And on the other hand, those few who have saved and maxed out their 401ks give little to no thought about what they're going to do if even a modest market correction of 35% hits their portfolio, bringing it, in the case of the average 55 to 64-year-old's 401k account, from about $245,000 today down to $159,000 in such a correction, with no guarantee on when it will recover its value, and I will say more on that in a moment. But just before I do, I want to say that if you recognize yourself in this average and median 401k balance data, especially if you are approaching retirement age, so if you are in that bracket from 55 to 64 years of age, you need to consider the fact that even in the cheapest US state to retire, West Virginia, there is a huge gap between what you have in your 401k and what you'll need to get by. And I will say again, that is a gap that could realistically get bigger in 2025 and 2026, setting you back even further versus where you are today. And please screenshot this information now for reference if you plan on doing something about this. Because as I've covered on the channel before, with US Social Security set to become insolvent by 2033 at the latest, meaning that it could realistically run out of money before that, you may be having to cover a larger percentage of that retirement cost gap from your own personal savings versus what you've planned for. Or it could result in you simply working for a longer period of time versus what you've planned for, which is a reality that many people around the world are already facing due to a growing number of insolvent national pension funds. Now, you may be watching this and saying, this guy is totally exaggerating because the only sure things in life are death, taxes, and the S&P 500, and a crash is nothing to worry about because when you zoom out on the chart, you can clearly see that it basically only goes up, so just be patient if it corrects because it will all come back with time. And although that may be true for people in their 30s or their 40s, the closer you are to retirement, the more devastating a correction like this can be, and you have to prepare for them to happen at any time now or in the future, and we'll talk about how in a moment. But the fact is, the S&P 500 doesn't just basically go up all the time, and I think that is best illustrated here in this inflation-adjusted chart of the S&P 500 since 1928, which shows a period from 1965 to 1991, where the index didn't make a new inflation-adjusted high for 27 years, and another such period that lasted 15 years from 2000 to 2014. Now, before I move on to my next point, know this. I am not telling you not to own stocks or to sell all your stocks now because of this data. That is not the message of this video. So listen carefully, because I think taking advantage of a 401k is a smart thing to do. I even think taking calculated risks in the stock market is a great way to accelerate wealth building. What I am saying is, if you are one of the many people who are relying solely on stocks to pay for retirement, you may be in for a big disappointment depending on when it is you retire. And people who retire in the next few years are going to learn that lesson the hard way if this market corrects the way I think it will. Now, why I say it's so important to prepare yourselves with gold and silver, because that is an important part of my message. It is because when things are good with the stock market, like they are now with the S&P 500 at an all-time high, as you can see here, metals on a dollar cost average basis deliver growth and only slightly underperform stocks while significantly outperforming cash savings, which I have generously measured at a 3% return per year in this calculation, even though we've spent so much time over the past 25 years at 0% interest rates. But remember, that's the performance when everything is good and everyone is happy. But once we've passed that stage, and I think we are approaching that moment right now when we are going to get past that stage, the reality is that gold and silver deliver the safest haven and one of the best ways to supplement retirement income for those periods when you've retired leading into a stock market crash or slump. And what most people don't get is this. They will see this video and say, well, that was a great opportunity to buy the dip. And if you're 30 years old with plenty of time on your hands, I'd say that's probably true. But retirees are not buying the dip. They have entered the phase in life where they are unloading their assets in retirement. So in essence, they are selling the crash, not buying the dip, as they scrape by trying to make the last years of life as pleasurable as possible on the backdrop of financial misery. So although I don't have a crystal ball and I can't tell you exactly what is going to happen, I want to remind you all that these are my 2025 and 2026 forecasts as they relate to gold, silver, and the S&P 500. Now, just as a reminder, in December 2023, I gave you all my price targets of $30.13 per ounce on silver and $2,400 per ounce for gold as my 2024 targets. So I will be monitoring these targets closely and providing updates here on the channel, along with some updates on metals and real estate coming very soon for those of you interested. But I will add that even if those numbers don't hit exactly, what's important to remember is the direction we're headed in. Because just as the Federal Reserve panicked and cut rates in September 2024 because of a little stock market sell-off, you can be sure that they will panic again, and that panic will be triggered once again by a big stock market sell-off. And by the time the money printers are turned on again, interest rates will likely be at 0%, inflation will be ripping to the upside, and gold and silver prices, along with other hard assets like land and real estate, will be on the rise. But it's important to correctly position yourselves today before the storm, because anyone who has tried to fix their roof on a rainy day will tell you that they should have done it when the sun was shining. Now, just before we get to this video's viewer question, if what I am saying in this video makes any sense to you at all, please don't forget to sign up to Gold Silver Swap early to prepare yourself whether you are on the buy side of gold and silver or the sell side of gold and silver. Because if you're planning on retiring on gold and silver, or even just partially supplementing your retirement with metals, Gold Silver Swap will give you not only the best chance to build that stack at lower premiums as you prepare, but also give you the power to sell at better prices when and if that day comes that you need to part with some of your metals. So again, you can sign up for free at www.goldsilverswap.com, and the link to the site is below for early signups. Anyhow, moving on, it is now time to cover this video's viewer question. And please remember, you can leave your questions in the comments section of every video I do. I choose one to appear in each video, and you never know, your question may be the next one that I cover. And this week's question comes from Harry Kerr, and it is another question on the hot topic of asset tokenization, which was covered last week, and how that ties in with the great taking. And Harry asks, is it right to assume that when assets are tokenized by large banks with the blessing of governments, that all tokens for fully owned assets, like if you own your house without a mortgage, will be given to the current owner, whereas for assets purchased with a loan, the tokens will be split between the loan issuer, so the bank, and the person who took the loan based on an equity split? So although this will probably be the last question I answer on the topic for a while, I think Harry's question is important and allows me to tie up some potentially loose ends in what you need to know about asset tokenization and the great taking. And just as a quick summary for those of you who may not have seen last week's video, tokenization of assets is a process where all assets, including homes, cars, gold, valuable paintings, and more, are registered and split into smaller digital shares or tokens that people can easily buy and sell on the open market. And this idea is being pushed by major banks as well as the World Economic Forum. Now, to get right to Harry's question, I want to say that his understanding of how it is expected to work is perfectly correct. Because if all assets are tokenized, and it's not clear whether that will be done by law or on a volunteer basis, if you own your home outright, you will receive all the tokens to that property in an account for you to do whatever you want with. Meaning, if you own a rental property, for example, you can sell some shares in that property quite easily to raise cash if needed, with the consequence of that transaction being some kind of tax and loss of a percentage of the income you get in proportion to the amount of tokens or shares in that property you sold. So I hope that's clear for everybody up to this point, but as always, there is a catch that you need to be aware of, because last week I warned you all about how tokenization makes it easy to gamble away your assets on the financial markets. And that remains true, and it's ultimately why I think banks like this idea so much. But something I didn't address is the fact that many loans which are not backed by anything can be paid for in a tokenized world using your asset tokens. And that becomes especially true in the case of unsecured debt. Now, what is unsecured debt, you're asking? Well, that is debt like credit card debt that has nothing backing it up except for your reputation. And today, that means if you can't pay it back, a credit card debt, for example, there is really nothing the bank can do about it except for tell everyone else that lends out money not to lend money to you anymore. But in a world where all assets are tokenized, guess what? Shares in your home, your car, anything you own can be used to secure that debt. Meaning if you've been relying on your credit card to pay for groceries because the Tweety Bird lady did an oopsie and printed too much money, and you can't pay that money back for some reason, let's say because you lost your job or had an emergency that ate into your savings, without even informing you about it, the kind people shown here, many of whom you probably recognize from the time they begged Barack Obama for hundreds of billions of dollars because they played a game of high-stakes blackjack with the world's financial system, they can transfer shares of your assets to themselves, thus covering the debt, and then start charging you to use their share of the assets, which, if you can't afford that, will result in a slow transfer of more and more shares of your assets to them until you are left with nothing. Now, when I talk about this stuff, please don't go off the deep end with your imagination and assume what I am saying is that gold and silver are your only salvation and that all other asset classes are rubbish. That is not what I am saying, and I think the fact that many of the wealthiest people in the world are also major real estate owners is enough to back me up on that and support me when I say how important land and real estate is, but I will be covering that topic in depth next week. In a nutshell, what I am saying is this system is being designed to take advantage of the unlucky and irresponsible, giving banks and governments better access to your assets if you make a mistake or become the victim of bad luck. So remember, your future is in your hands, and how you choose to allocate your hard-earned money and manage your asset portfolio is also in your hands, and I believe it will remain in your hands, but the environment we operate in is becoming riskier and riskier with each new idea and each new financial product the banks, with the blessing of politicians they have bought and paid for, invent. So Harry, I hope that answers your question. With that said, that's it for this video. If you enjoyed it, please remember to leave a like. And if you think you know somebody who would benefit from hearing the message in this video, please don't be shy and share it with them. I always appreciate when you do that. And remember, if you're new to this channel, please subscribe if you enjoyed this content and would like to see more like it. But as I say at the end of all of my videos, I want to say, please remember to take care of yourselves and take care of each other. See you in the next video. Goodbye.